All right, everyone, welcome back to this week's episode. We have a stacked episode for you today. Lots going on. We are going to first dive into mortgage payments and how they're going to be even further affected by next Wednesday's rate hike announcement. Rental restrictions, yes, those have been removed. They've been abolished. We're going to talk all about that as well. Then we're going to get into a bit of the national home prices because that data is in, and hot off the press, we have the November numbers for here in Vancouver. And then lastly, we also want to touch on the Bank of Canada and their recent Q3 loss, posting the first loss in their 87-year history. Lots to talk about. You're definitely going to want to stick around for the Vancouver real estate prices because that shocked even us. So let's get into today's episode.
Guys, it's Ryan Dash here, along with my co-host Dan Wertel with eXp Realty, and we create videos like this every single week to give you all of the education you need about the Vancouver real estate market. So do you have a property you have questions about and you're not sure what to do next? Maybe you're thinking about getting into the market and you're not sure if this is the right time. Well, if you've got real estate on the mind, call us. We are available for 30-minute calls whereby we can hear you out, what you're looking for, and how we can best help you navigate this tricky market. To connect with us, if you're on YouTube, just click that Calendly link below and choose a time that works for you.
Yeah, please do. We love to talk real estate and we love to help people with their unique situations. So right off the top, as we discussed, mortgage payments, they are already quite painful for those with variable rate mortgages. And now, of course, we've got another rate hike coming up next Wednesday. Unsure yet how much it's going to be. The current forecast is either going to be a quarter point or a half point. Either way, this is going to push those mortgage payments even higher. So for reference, practically every mortgage taken out during the pandemic, so let's call it from about April, May of 2020 up until now, essentially has, and I am talking about variable rate mortgages, essentially has 100% of that payment going to interest. And yeah, exactly. It's a bit of a terrifying number. And this is, of course, extending amortizations. And this is what we've been talking about for some time in regards to people's rates being triggered, right? They've hit trigger rate levels. And we've discussed and interviewed mortgage specialists on how to handle that. So we're talking here too about 50% of all fixed payment variable mortgages. That is a huge amount of mortgages. And it's 50%. It's about 50. And also about 13% of all mortgages in existence are now sitting at that point where they're essentially just paying interest. There's no principal being paid down here. Now, of course, as I touched on earlier, there are a number of ways available for people to catch up. They can make lump sum payments, they can increase, they can refinance, etc. Now, one of the big things I've discussed for a while is, of course, banks don't want you to default and they want to help people pay their mortgages essentially. And so what is one of those levers that they can pull that we've been discussing for months and months and months and months? 40-year amortizations. And guess what is kind of available as of last week? 40-year amortizations. This is not for everyone. You can't just go to the bank and say, I want this. These are basically on emergency request. Right now, at least, there's a couple of the big five that are letting their borrowers say, look, I'm in trouble here. I'm having a hard time paying my mortgage. Can we extend that amortization so my monthly payments are smaller? And case by case scenario, of course, but these are essentially being approved. And again, why are banks doing this? Banks don't want to own your house. They don't want to go through litigation. They don't want to take your home to market. They just want to lend you money and get paid interest on that. So they're going to help. It's just their nature, right? This is how they make their money. A second option has also come up just within the last couple of days. Other banks are allowing the extra interest to essentially be added to the principal and being extended in the total amount of their loan. So let's say you borrowed $1 million and now your your interest is actually more than your entire payment. And so it's being added on to that initial $1 million. So that at the point of the refi, for example, they're going to refi on that new amount. Not a great scenario, but a lot better than not having a home, not having a roof over your head. So again, banks are already finding ways to change the rules, if you will, to make sure that home buyers stay in their homes. Now, this is extremely painful for many, and understandably, when I think National Bank just came out and said 67.3% of income right now is going to service mortgages. 67%, 2/3 of the average income. Exactly. So this means, that's the highest it's been since 1981. Okay, we're at a 41-year high. And this is the average home in Canada, which, as you know, is priced well below the average home here in Vancouver. So the Vancouver pain is obviously and understandably a fair amount higher. So that's kind of where things stand today. And yes, it will get squeezed even more next week. Now, when we're talking again about the typical Canadian home, mortgage payments on that typical home hit another all-time high. The typical payment now is $3,250. That is up double, 100% since January of 2021.
My goodness.
In less than 2 years, the average mortgage payment has doubled. So understandably, people are stretched. 47% of the people polled right now, when it comes to asking them how they feel about their finances, they all feel worse. Or not all, but the 47% feels worse. And that's the highest percent since the poll was created back in 2008. A bit understandable because, of course, the wealth effect was in full effect last year at this time when people were feeling very wealthy. So understandably, about half of people polled right now say that they feel financially worse off than they did this time last year. So understandably, consumer confidence is in the dumps. Essentially, it is as low as it was in the depths of the pandemic when we didn't know if we were going to lose half the population. So where does that leave us now? How much worse can it possibly get? Or is it time to get better? Was that the bottom? Well, let's look to the States, where the head of the Fed, Jerome Powell, this week, just stated that basically the end of the rate hike cycle is near. And that was very welcome news as we saw the stock market rocket north almost immediately, definitely affecting real estate stocks as they will benefit from a flat or, of course, downward pressure interest rate environment. So I think, please take it.
I was just going to say it'll be really interesting too, because, Canada, in terms of its debt to GDP ratio, is pretty bad comparatively speaking to the US. What I mean by that is the US can continue to raise rates and not put a ton of pressure. Well, there's already quite a bit of pressure, but not comparatively speaking to the kind of pressure that would happen in Canada. We are far more in debt than the US. So if the US continues to raise rates, it'll be really interesting to see what the Bank of Canada is going to do, because our debt levels are much higher, meaning they can't continue to raise rates without breaking everything. So it'll be really interesting to see how that plays out. But with that said, let's move on a little bit and let's get local here and speak to the fact that David Eby has abolished rental restrictions in strata buildings across the province. So I personally think this is a welcome news. I've been so frustrated many times as a real estate agent trying to help both investors, sellers, buyers get into buildings where they are not dealing with rental restrictions. So this is going to have I think, a great impact, both with respect to easing the rental market. We know that the rental market got way too hot. So it'll be really nice to see some of the prices come down in areas where, maybe rentals haven't been allowed for some time. With that said, the utility of some of these apartments where rental restrictions kind of kept prices deflated, we should see some marginal increase in their value. I don't know, maybe 3 to 5% in terms of its total price. Maybe some good options there for investors looking at decent cap rates too, where they can take advantage of these higher rental rates with a lower purchase in some of these areas that have been depressed for years. So I think it'll be welcome news. I think the market will generally respond well to it. What's going to be kind of interesting, though, is secondary properties that were in restricted buildings become a sudden burden because they're no longer exempt from these rental restrictions. And Dan, I think you have a story with respect to a client who's gone through something quite similar.
Yeah, something that's not being talked about too much here because it is a smaller segment of the population, of course, but it is a real one. And it's typically going to be the wealthier client who is going to find themselves in this situation. And yeah, for example, I've got a client with a very nice home in Vancouver or in West Vancouver. And he loves to come downtown to his Yale Town pied-à-terre to watch the fireworks, to get some time away, to host friends and family so they can stay when they visit the city, to use as an office away from home, whatnot. That property he uses definitely less than the 6-month requirement. But he's able to do this and not pay vacancy tax because there are rental restrictions on that building that only allow 10% of the building to be rented out. They are fully maxed out and they have a waiting list. So that is an exemption that he can tick off at the end of each year. This year, 2023, he won't be able to do that. And okay, so what does that mean? What are the taxation implications at that point? Well, this is a $2.5 million waterfront condo. So if you take the empty homes tax at 3%, there's a nice $75,000 tax bill waiting for him at the end of the year. And then another 0.5% for the vacancy and spec tax, which would now apply as well for another $12,500. So this person is potentially on the line for $87,500 now that he wasn't last year, just from owning a secondary home to enjoy. Now, the question is, yes, boo-hoo, sob story for someone who can afford this. Okay, sure. But again, think of what's happening. Maybe now he's forced to sell because he doesn't want to pay that tax. And now he's forced to sell in a market that is very slow, that is much colder than it was through the peak. And he didn't, if he knew this was coming, if there was any type of advance warning, maybe he would have made a different decision. Again, or maybe he'll rent it out, but maybe he doesn't want to rent it out because he wants to use it or again, host family and friends. So it's quite complex. It's going to affect people like that. And if you are in that situation or know someone in that situation, feel free to call us, of course, to discuss it. But this is definitely taxation. So you're going to want to talk to a real estate lawyer as well to truly understand the implications of what it'll mean for you and your property.
Yeah, I tend to agree. So, okay, well, let's move on now to talking stats. This is what y'all came for. So I'm going to touch on the national statistics here, and then Dan will take it into the GVRD. So Canadian home sales ticked up 1.1% in October, the first increase since February, but they're down 36% from this time last year. So take that as you will.
Yeah, we know it's slow out there, of course. Even GVRD here, lowest since 2018, 4-year low in sales. We just did 1,625 units just last month.
Ugh,
it's a great freeze out there in more ways than one.
Yeah, it's not just snowing; it's freezing. National active listings in Canada are up 2.3%. I'll take that. That's the largest increase since July. However, I think here's a bit of a different story.
Again, we talk about how different Vancouver reacts or acts than the rest of the country. So we just saw the largest increase in active listings in Canada since summer. And what did Vancouver do? Dropped another 6%. So completely different. It's just the demand here is different and the people that are listing are different. And I think from both sides. Yeah.
And I think the constraints are different here too. There's a lot of geographical constraints here. There's a lot of ALR land that's not going to ever be rezoned for density. So we have a lot of pressures here that don't exist in other cities throughout Canada, right? So with that said, speaking to inventory, national months of inventory is about 3.8. So climbing, we need, again, between 5 and 6 months to normalize a marketplace to create some balance, right? So we're still under that.
And as well, national prices dropped again 1.2%. So we are certainly well off the peak. And we just, as of literally an hour ago, have the stats for Greater Vancouver for the month of November. So we're going to get into those as well, give you that micro picture. So we just touched on sales and the volume. It was about 1625 for the month. But what does that look like in comparison to our recent history? Well, they're down 53% from November of last year. Less than half the units sold this time last year happened just last month. And again, last year was one of the all times, but hey, cutting that in half is no small measure.
No.
The amount of sales actually increased from last month, if you could believe it, by 15%. But we are so far below the by the 10-year average at about 37%. And over the last 6 months or so, we've been saying about 25%. So the sales volumes is getting worse and worse and worse.
Mm-hmm. Let's touch on listings. So there were 3,055 new listings in November of 2022. This is a 23% decrease compared to November last year and a 24% decrease compared to just last month. So again, a bit of the story here, Dan, of people having locked into low rates, not necessarily wanting to sell in a marketplace that still needs to improve, I think, generally speaking.
Yeah. And sorry, I completely misquoted. I just said there was a 15% increase in sales. Obviously, sales are down. I meant to say decrease, so little asterisks on that. But yeah, obviously, lower sales, lower listings. But what are we back to? What's the big story? Inventory. It's been the most fascinating aspect or element of our market to watch, and still is. So we have now had our 5th monthly decline of inventory in a row. We're now sitting at about 9,200 units. And before we used to have that 10,000 ceiling, and now we're well underneath that at 9,200. We're essentially back to April inventory levels, when April was when it kind of just started to decline, because we were just at the very, very tail end of that 2-year crazy bull run. Inventory, interestingly, is about 28% higher than this time last year, because again, it was being absorbed like crazy just
way
this
faster
time last year. Yeah. And inventory dropped about 7% from last month. It is tanking. And again, it's largely what's kind of keeping prices stable, which we keep saying. If you had double the inventory, prices would not be where they were. And we're going to dive into that momentarily here.
Yeah, and I think it's also reflected in the sales to active ratio, because we're looking here at generally speaking, a 17.6% sales to active ratio. So that puts us in a balanced market, generally speaking. Although I'd say balance towards the seller's market, not towards the buyer's market. So we'll see how that continues to trend. I mean, if we continue to go down the number of sales that we're having here, that should decrease. We are 1.7% down from last month, and 5th month in a row where we have been in a balanced market. Again, guys, never dropping below that 16%. So really no chance of entering a buyer's market, even with the current landscape. Again, this is an inventory issue. I think more than anything, if we had more inventory, I think that number would be lower.
Jumping into price now, a bit of a surprise here when it comes to the HPI. If you listened to last month's episode, I had predicted the HPI to remain flat based on, of course, what the average median had done. But there's a change in the properties that are selling right now. And of course, we saw HPI, it actually dropped 1.5% last month. And I predicted zero change, but we're going to get into that. So it dropped about $17,000 last month. The average home price now sitting at $1,131,000. It's half a point, 0.6% decrease from November of last year. And what's interesting, what is the biggest note about that, is that's the first time in 1 year where we've said prices are lower today than they were 1 year ago. So that is the cycle. So essentially all price increases that happened within 2022 have now been erased. We're actually slightly lower than we were this time last year. We are now 11% off of the peak, which happened 7 months ago. Diving into the two other types of pricing that we look at, median stayed exactly the same at $920,000, which is, again, we're 8% off the peak in the median. We're basically back to June, or we're even above June prices, somewhere between May and June. And average definitely dropped about 41,000 last month, just sitting right over 1.2 mil, only down 1% since June. So again, we've got since June, both median and average are essentially within a couple points of where they were 6 months ago, which is very interesting. So we've had flat prices for 6 months here. We are with the average 12 points off the peak. So you've got median down 8, average down 12, and HPI down 11. So Dan, why did HPI drop so much? Yes.
I just want to make a contextual comment here so people understand, because it's interesting when you made the prediction and then looking at the median price having not changed. So how did HPI drop, right? And I think when we take a look at the stats pack and we look at the difference between, say, East Vancouver and Vancouver West, Vancouver East versus Vancouver West, we've seen, price declines 4.5%, 5% on the west side and 0.2% on the east side. And it's an important distinction to make because properties on the west side are far more expensive than those on the east side. So we're seeing movement in price points that are probably above that 2.5-3 million mark versus price points that are in the 1.5 to 2.5 million mark on the east side. I just want to make that. I think it's contextually important.
Well, that's exactly why it moved as much as it did. Keep in mind, the HPI is hedonically adjusted. So depending on which type of properties are moving the most and seasonally adjusted as well is kind of where I put it where it is. But either way, you kind of have the three ratios there. We're down essentially between 8 and 12%, depending which element you're looking at there. That's definitely the key aspects of the stats for the month of November that we wanted to share with you guys. And if you've made it this far and that's what you wanted to hear, great, because we're going to do a bit of a deeper dive into what just happened at the Bank of Canada last quarter. So it is very fascinating to know that in its 87-year career, the BOC has never posted a loss. And last quarter, it actually posted a $522 million loss.
That's
a huge
big
number. It's very big. And so what's happened here is they had a year ago, $814 million revenue. And in this quarter, $350 million negative. So, sorry, that's just on the interest revenue that they make, not the net revenue. So that's over a $1 billion swing in their revenues there, which is obviously what attributed mostly to the losses. And if you're curious about how the Bank of Canada actually makes money, well, it's essentially from having the asset that is mostly generated from the difference between the value of the currency that the central bank issues on behalf of our lovely government and the cost of producing it, compared to its liabilities, which is essentially the money deposits from our country's biggest financial institutions. Private lenders, keep in mind, they need to keep enough money within the BOC as well to clear their large payments. Now, what's changed? So in 87 years, because that's a pretty good run to never post a loss.
No kidding.
Well, COVID changed things, understandably, because the Bank of Canada, like most central banks, has a very unique position where they can actually print money. And it did this during the pandemic, of course, and you've likely by now heard the term quantitative easing or QE. And essentially why they print so much money into a system in a position of when there is such a thing as a pandemic is it stabilizes the financial markets. It provides lenders with a source of liquidity when financial institutions are essentially fearful of letting go of their cash. Now, when the pandemic hit, the banks looked to history to see if they had any type of references to what to do and how to save their country and how to keep people calm. And the most relevant, I guess, was the Great Recession. So in the Great Recession is when the Fed first successfully deployed that earlier discussed quantitative easing. And it essentially got them out of the recession or made it less impactful as it potentially could have been. So the Bank of Canada said, okay, well, we're going to do that too here to keep people, out of a recession. And they're going to be proactive because essentially on the other side of the Great Recession, and when it was researched, it was essentially determined that the recession would have been less severe had the Fed acted sooner and with greater force. So the governments, both Canada and the States, and a lot of the other G20s here kind of decided, okay, that's our blueprint. Let's go big. And if you remember, the Bank of Canada here had hit a peak of issuing, I think it was $5 billion per week, gobbling up that government debt via way of bonds. This took their balance sheet from about 120 billion pre-pandemic, March 2020, up to $575 billion.
These numbers are just like...
Yeah. Huge. Over $500 billion on the balance sheet. So then, of course, with this money pumped into the system, with with people told to buy homes, with home prices appreciating so much, with the wealth effect in full effect, people feeling very wealthy, they went out and started spending a bunch of money. That kicked in inflation that got pushed up. And so they had to fight it by then raising interest rates. As we know, interest rates are up, 375% since the beginning of the year. Now, the side effect of that, of course, is that when you ratchet up those interest rates so quickly, the cost of holding all of these bank deposits now exceeds the value of their assets, which essentially means they put themselves into debt to save the pandemic, pumping money into the system, lowering rates, increase housing demand, and make people wealthy. But then, of course, they now have interest payments themselves that they have increased on themselves and they can't pay for themselves. So it's a bit of a circle here. But of course, it's a problem. And somebody's going to have to pay for that. Brian, why don't you discuss who's going to foot this bill for what the Bank of Canada has done to themselves and thereby us?
Yeah, I mean, generally speaking, it's going to be us, but I also think it's not only going to be taxpayers in today's day and age. You know, like you said, Dan, $500 billion in debt doesn't just go away in one generation. So I tend to think that our children will likely be paying for some of this as well, which is very unfortunate. And part of me feels like I want to, in some way, shape, or form, look at what the bank was faced with when the pandemic hit, right? And they were sort of faced with, well, we've got to keep the economy going, so we're going to dump cash into it. Okay, fine. And we learned that from the last time round. But where it got kind of crazy is they were probably looking at, well, do we go into a depression or do we deal with inflation and then cut it back later, right? And I think dealing with inflation was probably the lesser of two evils. However, that's not what they communicated. And that's the issue, right? The issue here is that both of those decisions will have consequences that create casualties. And they could have done a lot more to warn people, and they could have also acted a lot sooner. Let's not forget here, the Bank of Canada waited until inflation hit 6.7% before they introduced interest rates. And then they put their foot through the floor with it, realizing that they had waited too long. So say what they will about what they learned last time, but they didn't act on it the way they should have. And this sounds really familiar, doesn't it? Because this is what happened in the global financial crisis, right? You got to remember, back in the depths of 2020 here, Tiff came out, and like I know him, Tiff Macklin came out and told people to buy homes, take out that money, go and spend it. We'll keep rates. We promise you, we'll keep rates, flat, bottom until the end of 2023. And then they just pumped in all of these billions of dollars, right? And they did so. In doing so, I should say the opposite kind of happened, right? Inflation took off. We didn't see any kind of restrictions with who they were giving money to. Money was just getting written and checks were getting written and people were taking advantage of the situation. There was all kinds of issues with it. And then we pumped in like $400 billion, something crazy, into our economy. And, then the Bank of Canada is like, oops, how did we get into this mess? And what a mess they created. The problem here, Dan, too, is that when businesses get offered money, they get a competitive advantage over their competitors. So they'll go and take that money. They'll go then and hire other people and pay them more to try and take an advantage over the competitors, naturally. So, but then what do the competitors do? They do the same thing. So all of a sudden, you start gobbling up people, you start paying them more, and then Tiff Macklin comes out and says, well, the problem with inflation is that everyone's getting paid too much. Well, where did the money come from? Right? So it's one thing to do that. And then, when you look at Australia, for example, their central bank governor, Philip Lowe, came out and offered an apology, an actual apology. Well, sort of. He came out and said...
It's a bit backhanded for sure.
Yeah, he quoted here, well, I'm certainly sorry if people listened to what we said and then acted on it. What we said, and now we kind of regret what they have done, but sorry doesn't help pay the bills or turn over the situation that they created. I mean, an admission at any level is maybe a good step, but decisive communication and coming out and saying, hey, listen, I know we talked about doing this, but we're going to have to do this. Slam the brakes. People, slow down. None of that was said. People look to the Bank of Canada for guidance. And like I said, they not only did a terrible job here, Dan, not only blaming people for earning more money, this is all the while the Bank of Canada handed out $18 million in bonuses to their own people for failing. Anyhow, I'm a little mad about it.
Yeah, it's like we said before, they've kind of lost basically all credibility here based on the actions over the last 2 years, and then just pointing fingers. You know, even though it was a backhanded apology, at least they made one in Australia. Take it for what it's worth. Again, it's very hard to look to the BOC for any kind of realistic guidance moving forward here, or until at least maybe TIFF is out of power. We know Pierre Poilievre is campaigning that he would fire him, but that's for another day. I'm not a politician. I'm not in politics whatsoever. But either way, we know what they're saying, so it's hard not to be involved at some level or another. Thank you, as always, for watching and listening. Glad if you made it this far. Quick reminder, if you are considering making a move in the real estate market, we would love to chat with you. Please book a time with us. It's a 30-minute consult, and the link is below. Thanks again, and have a great weekend. Bye.